is global instead of local, because we did digest a fairly good consumption-driven budget. However, today's fall came out due to Trump's first wave of tariffs, which caused a rattle across the markets. Sensex did settle with 300 points loss, rebounding 400 points from day's low, and Nifty settled with about 100 points cut below that 23,400 mark. Mid-cap and small-cap indices that continue to extend their losses for the second day. Small caps face a sharper decline of about 2%. India Wix above 14 mark, and energy and oil and gas indices, they were the worst hit as some of the profitability concerns emerged on lower LPG subsidy post the budget. But yes, consumption stocks and the auto and consumer durables, like the budget boost has given them, they did fairly well and held up in this otherwise weak market. But Yatin, as investors digested the budget, Trump's first tariff missile is fired, and now plenty of uncertainty is there on how it will impact on the Indian markets. Yields are up, so is the dollar index.
Lavisha, as you rightly put that Trump's tariffs are not only uncertain, they create a knee-jerk reaction in global markets. Today, the Dow futures were down 6%. When Trump announced the intention to slap a 25% tariff on goods imported from Canada and Mexico. Not only that, he put a 10% tariff on Chinese goods also. Tariffs are not that great. They increase inflation in the local markets and probably jitter the entire global trade. Let's see how this Trump tariff war pans out, because I'm sure that he has some things in mind for the BRIC economies as well, including India. So whether or not he imposes some tariffs on India, how does it really work, is something that we'll watch out for. But yes, for the time being, it has impacted the markets. Locally, the markets are busy digesting the budget. Advance decline ratio in the market was almost 1:3. So one stock gaining, 3 declining. Energy, metal, and FMCG stocks clearly saw some bit of selling. But yes, overall, I think it was a good budget, keeping in mind that consumption revival is something that everybody's looking for. And obviously, on Friday, we have the RBI policy. All eyes on that as well.
That's right. As you said, that consumption-driven stocks. And in the Nifty 50 gainers also, we saw some of the consumption names which did well. Auto companies, M&M did do well in today's trading session. And after it posted a decent and a good January sales figures as well. Maruti and Eicher Motors also surged in the trade. And we can see about, 2% gains coming in for both of them. Wipro, IT names also dominated the list. More than 2.5% gain coming in for Wipro. Shriram Finance, Bajaj Twins did well. Bajaj Finance, 5% uptick. Bajaj Finance, definitely in the last 30 minutes, we saw that the stock also did hit a record high levels as well. On the other hand, on the flip side of the top losers on the Nifty 50, we can see some capex names which have dominated the list after a very lukewarm capex target which was set out by the government. L&T with about 4.5% cut. Coal India, after a weak set of January production data, also saw about 2.5% cut. We can see some of the auto names which have cropped up in the list, which is your Tata Motors, Hero MotoCorp, 2.5% cut coming in then for that as well. Tata Consumer Products did see off about 3% cut as well. But mid-cap and small-cap indices, once again, second day of losses. Yatin, what do you gather from there?
So overall, the mid-cap end of the market was, not that active. A lot of profit taking there. However, consumption stocks like Bata did well. Aavas, Happiest Minds, GSPL were the other gainers in trade. What was not doing well is the entire PSU basket. The railway stocks, stocks like RITES, stocks like RVNL fell, 5 to 10%. Companies like NCC, because the infrastructure spending was expected to pick up, especially in the road front, that stock saw a 6% cut coming in. If you look at the FNO space also, there were a lot of stocks which saw a lot of selling, especially the likes of HUDCO, because affordable housing, the expectation was that the allocation will be increased substantially. That there was some disappointment. Defense stocks like HAL, BEL, BDL, all of that saw some selling of 5 to 7%.
That's right. Now, let's quickly break down some of the stocks that did come under the limelight in today's trading session. Well, the first stocks in focus, that were your auto ancillary names that came under the pressure after Trump unleashed the first round of tariffs. We saw the shares of Sona BLW as well as Samvardhana Motherson that tumbled up to 9% today after Trump imposed 25% on imports from Canada and Mexico. Now, since Samvardhana gets 4% revenue from Mexico and Sona BLW also gets about 2% revenue from Mexico, the tariffs could lower demand for the auto parts and their revenue could face some volatility. Analysts at Elara Securities also came out with its note in today's morning and they have pointed out two major impacts. First, as tariffs make Mexican assembled cars more expensive, the US sales of General Motors, Toyota, and Volkswagen models, all of which are highly made in Mexico, might see a decline, and that could eventually reduce the demand for Indian made auto component parts. Second, they have pointed out that these OEMs might rethink their production out of Mexico. Here is where the Indian suppliers could face some logistical challenges in rerouting the supplies as well. However, on the flip side, the 10% tariff on China could make Chinese auto parts less competitive, which could prompt US automakers to look for other alternatives. Here is where India could benefit because if US firms seek out for alternative suppliers, that would mean a plus for India as well. But yeah, then now the outlook for these stocks, for these auto ancillary stocks, depends on if they can absorb these tariff costs or even shift their production. What is your take?
So I think if you look at the auto ancillaries, clearly there is a pressure. Obviously, if you look at the companies like Motherson Sumi and the companies like Sona BLW, they have a very large export presence. And in case of a EU tariff, because Trump also indicated that he would look at tariffs on EU products also. So if you have a tariff which comes on EU auto ancillary products, EU car products, then obviously the global demand really slows down. Especially in the times of trade war, we have seen there is a lot of uncertainty, especially around the auto ancillary space. And we had Trump, which always has said that he would like to look at the automotive industry coming back to US when it comes to manufacturing heavily there. Obviously, so there is a question mark on the auto sector, because of which we saw some selling, especially in those export names, especially in the auto ancillary segment.
That's right. As you were mentioning about European and European markets have also opened with quite a bit of a cut. We can see the likes of Renault, Volkswagen, BMW, all of them seeing a cut of about 7%. But let's move on. Like we've been talking about the budget theme stocks, so how can we miss about the railway stocks? Well, as expected, they were under the pressure for the second day after budget kept capex allocation for the sector unchanged at 2.5 lakh crore rupees. We saw the likes of RITES witness the biggest fall among its peers, falling as much as 8%, while those of RVNL, IRFC, Ircon International, fell to up to 5%. Now, the ministry's internal and extra budgetary resources that has also remained static at about 13,000 crore rupees for FY26. Now, this unchanged capex allocation also comes at a time when the railways did require substantial funds for its infrastructure expansion and multiple projects left as well. Yet then, the railway sector was anticipating about 18 to 19% capex allocation, but no major announcement came in from the budget, and looks like the party could be over for these railway names.
So, I think the allocation was almost flattish for, road infrastructure, for defense, which was expected on the higher side. We also had the railways wherein the allocation is flat. In a scenario wherein, all of these railway related stocks are trading in multiples of more than 20 times, 30 times, 40 times PE ratio basis, obviously it warrants a correction, because when there is no growth in the government spending, the fear on the market is that, the current order books won't grow that much. So if the growth part is missing, probably the market would look at profiting. Any which ways, we have seen post the third term of Modi start, PSU stocks have been hammered at every rise. So PSU stocks have seen a derating. In fact, CLSA today in the note mentioned that a lot of these PSU stocks would see some bit of pressure, given the fact that the budget was slightly disappointing on sector specific capex requirements.
That's right. But let's move on to another. Yeah. But let's move
So,
on.
Lavish, I would like to talk about the oil and gas sector also. Since we are talking about the PSU names, after railways, oil marketing companies also saw some selling pressure. In fact, even at current valuations, we are looking at a sell-off in IOC, BPCL, HPCL, because the government did not chalk out the plans to give the LPG subsidy which is due for the current financial year for the next budget estimate. So there was an expectation in the market that the LPG related subsidies would see some compensation element or some figures in the budget estimates, but that weren't kept inside the budget. In fact, in the case of this uncertainty, brokerages like Jefferies believe that the oil marketing companies would probably have to bear nearly 69% of FY25 under recoveries on regulated products after a gap of 9 years. In fact, the LPG subsidies which were compensated via the budget this time mention, which probably is seen by the market as an uncertain portion. In fact, today Jefferies has reduced the price to book multiples for all of these oil marketing companies by 10%. They have cut the target of BPCL to 330 from earlier 370. IOC, the target is cut to 150, which was 170 earlier. And if you talk about HPCL, here also the target has been cut by nearly 25 rupees to come in at 270 rupees. So yes, slightly uncertain on the LPG burden, and probably no clarity on that front led to the fall in oil marketing companies.
That's right. But let's move on to another stock in focus. That was your ITC. Well, the entire consumption basket was under focus today, but ITC clearly a street favorite. The stock did not perform well in today's trading session, but became quite a talking point because Jefferies did share a buy call on the counter with about 550 rupees per share. As target price, while Morgan Stanley also shared an overweight call on the counter and shared a target price of about 554 rupees. Jeffrey said that ITC has emerged as a winner as the government did not tinker with any of the tobacco tax, which was expected, and analysts also believe that the GST rates are likely to stay stable until March 2026, until the center settles dues to the states. A plus also for the stock has been the personal tax rate cuts that will help consumption in general as well. But on the other hand, Morgan Stanley sees ITC well placed for sustainable growth with strong business fundamentals. Yeah, then after a really bad January month, the stock has again picked up its pace and is now just 9% off its record high levels, which it had hit last year. So, do you concur that the street will also be quite favorable towards it in the coming days?
Well, ITC is one stock which is, underperformed recently, but with the uncertainty going off when it comes to
Mm.
taxation on cigarette, probably focus on consumption, especially on
Mm.
the rural side where ITC has a good presence, would probably keep the interest in the entire sector as well as the stock of ITC. Today, we saw some bit of selling pressure at higher levels because, typically we have the trader interest which is there in the first, second half, probably market adjust along with the FI flows. But overall, FMCG is one sector which probably will remain on the investor attention list, especially after the renewed government focus. Instead of capex, look at consumption.
That's right. All right. With that, we've come to an end of this edition of the opening closing bell. Tomorrow we have some consumer names, Titan and Asian Paints, which will be coming out with its Q3 scorecard. So keep them under your radar. Until then, signing off, Yatin and me. Thank you for watching.